Keith and Steve, how are we doing today?
Hey, Ryan, how are you?
I'm doing great, Ryan.
I'm sorry, I gotta laugh. We keep doing that, and I should direct that towards someone. So, Keith, this is our third or fourth one now, and it happens every time. So, I just got to get a good chuckle out of that. So, Keith, I'm very excited to have you on the show with Steve and I. And why don't you give everybody a little bit of your background and what you guys do?
Yeah, I'll take the lead there, Ryan, since we kind of fumbled in the intro there. I run a business succession planning practice out of Washington, D.C. It's a 10-person team, national practice. We help business owners decide when to sell, how to sell, all the various strategies to include ESOPs. And on the back end of it, we run really a family office inside of a leading bulge bracket bank to help them with holistic wealth management on the back end. Most importantly, I'm a proud father of 2 little girls. I have a 9-year-old and a 4-year-old. To keep you honest, those are the things that matter.
Nice. I got twin girls that are almost 6, man. So support.
Yeah.
So Steve, I know you wanted to tee up the first question, so why don't you go for it?
Yeah, I think, to get more, I've known Keith for, I don't know, we're 3-4 years now that I met Keith, and starting to know a little bit more about his practice. And I think, what really can talk about his practice is this myth that we've talked about on other podcasts that we've done. This is our 3rd or 4th one I think we've done, Ryan, and excited to have this employee ownership month. So thank you for doing this. But the myth that's out there is that, ESOPs are complex and expensive, and more complex and expensive than other exit options. And because of that, I think that's one of the keys to why ESOPs are not more used, is there's just these myths and misunderstandings. So Keith, I know you bring, like you said, a holistic approach. You're a business owner. I'm here to help you. Can you address that myth right up front about ESOPs being more expensive and more complex versus other options since you get in there? And what do you tell your clients and how do you work with them?
Yeah, it's a great question. I think there's a little truth to every comment. ESOPs are more complicated. So let's kind of unpack the question. There's two questions within the ask there. Look, an ESOP is going to be more complicated, Steve, than an outright sale to a third party. An outright sale to a third party, you're going to take a company, you get an offer from a buyer, you look at the after-tax proceeds of it, and you either say yes or no, and you're kind of leaving the company more often than not. With an ESOP, you're understanding, a tax-efficient transaction that is going to have an element of complexity of understanding what it means to the company, what it means to the employees, what it means to you as a seller. Oftentimes, you're going to stay involved with the company. But complexity should not be a reason not to do a transaction, because complexity just means it's something new. And what's beautiful about ESOP transactions are there's an entire community out there of professionals, whether they're lawyers or investment bankers or wealth advisors or CPAs or trustees or individuals on the valuation side, that this is all they do each and every day. And so to me, complexity is resolved with clarity. And the key, Steve, is before you make any big life decision, and selling a company is a life decision, we need to get the information. And so all the complexity goes to the side. If a business owner can pause, exhale, hire a team of advisors to properly explain and communicate what the ESOP actually means to them and their families, what it means to the company, what it means to the employees, how the transaction works. And what I've always found is if the client can repeat back everything that you've just explained to them, then you've done your job. It means they fully understand it. And then we take this complex transaction that's no longer complex because we've educated the owner, and we compare it to the alternative methods of a management buyout or selling outright to a third party. And we've positioned our clients well to make an informed decision as to what's the right path for them to monetize the business. So that's how I'd handle the complexity. Is you're going to educate a client, but through education, you're allowing them to make an informed decision. The mistake I have seen, which is part of the spirit of the question, is clients hear the word ESOP, their incumbent attorney or their incumbent CPA or their incumbent wealth advisor has never done an ESOP.
Mm-hmm.
They've never done it. They simply say, oh, those are complicated. So the owner never has the opportunity to figure out if it's a palatable solution. Because their trusted circle is just going to say it's complicated, so they walk from it, which is really failing the client. So
complicated, they walk from it, or they don't get paid to do it because they've never built out the practice. So therefore, there's some sort of billing protection.
Right. So they want to protect themselves from getting replaced, so they just tell the client it's complex. Ryan, you're spot on with that. And that's failing the client, which is obviously, as a service provider, you go to work each and every day to serve your client. And you want to make sure that the client has all the options from it. So the cost to me, Steve, is a myth. I really do think it is. If you go to sell a company outright to a third party, and we're completely agnostic. I work at a leading bank that has the capability of taking a company public and doing the roadshow, or having them go find a strategic or financial buyer, helping them with a management buyout or an ESOP. And here's the reality. If you take a $100 million company, I'll use that as a baseline, typical ESOP deal, $100 million enterprise company, and they go to sell outright to a third party, they're going to hire an investment banker more often than not, and they're going to hire a corporate attorney. And when you look at the fees that a business owner is going to pay, or a board is going to pay, to sell a business outright to a third party between the investment banker and the tax or corporate attorney, you take that as a waterfall and you compare and contrast that to what it's going to cost to hire the village of professionals, because there's a village in an ESOP deal. You're going to have 6 or 7 service providers. But what I have found is if you look at a side-by-side, the ESOP transaction, Steve, actually is condensed. It's lower outright aggregate transactional cost than an outright sale. And it really should be lower. And the reason is there's a much higher probability of execution.
Mm-hmm.
The reason investment bankers are able to charge a higher fee and should charge a higher fee for an outright third-party sale is they've got to get paid for all the transactions they go to market for and they never get paid on, because they can run a process and work a deal for 6 months to 24 months and never get the bid that the owner is going to take. And all of their fee was on the back end with the tail. Mm-hmm. So what I have found is the investment banking fees on an outright sale to a third party are much higher than they would be on an ESOP transaction, because on an ESOP transaction, you have a much higher probability of closing the transaction if you set the expectations at the onset. So with an ESOP, what I would say in summary is the myth is that the transactional costs are greater than an outright sale. You have more professionals involved, but I think as a side-by-side, they're going to be equal to, if not lower, and more often than not, I would say lower. Now, the second part of the fees are, to keep an ESOP in place, it's going to be awfully expensive. And here's the reality, Steve. There are going to be fees and expenses that the company is going to have to pay once you have an ESOP in place that they're currently not paying. Once you have an ESOP in place, you have to have an annual valuation. It's required.
Sure.
Right now, they're not getting that. You have to provide a $5,500 to a third-party administrator. But when you look at the ongoing compliance costs, they should have an ongoing trustee. Every company, in my opinion, should hire a trustee, and they should be paying a trustee because the trustee serves an important role. But when you take the cost of the trustee, these are the ongoing fees, and the cost of the valuation, and the cost of the third-party administrator, which are real fees, and then you compare that to the tax savings that the company has, particularly if it's 100% wholly owned S corp. If you have that same $100 million company that's right now taxable, and then ultimately it becomes tax exempt, and we quantify what the tax savings is for the company, and you compare that to the fees that they're paying to keep the ESOP compliant, we no longer view the ESOP as being expensive.
Keith, I know, man. Like, I'll tell you what, every time I get that pushback in one of our trainings or something, I'm like, wait a second, on $1 million in cash flow and you're saving $350,000 if you're in Minnesota, like, and you're going to complain about $35,000 or $40,000. Like, what?
Yeah.
That doesn't make any sense.
Because the expectation wasn't set at the onset.
Right. And Keith, in the spirit of this kind of conversation, I think, one of the things that I always hear as well is there's a delta between the intrinsic financial value of an ESOP compared to the strategic transaction value of a third party. And there's a spread, especially over the last 3 years, where the, synergies and the back office stuff of a third party sale, enterprise value could be more on a strategic or a private equity sale compared to an ESOP. But if you actually ran the net proceeds calculator over 4 to 7 years of the upfront cash, the tax advantage, salary, warrants, and the mezz financing, what is your thoughts as far as like how to compare the net proceeds of two different transactions like that?
Well, very well laid out. So I think here's the messaging that I tell clients when it comes into the financial planning side of the equation. Because you have to run a cash flow analysis to figure out is is the amount of money I'm going to receive in this sale on an after-tax basis enough to maintain my quality of life or my burn rate of what I spend every month.
Mm-hmm.
And what we've often found is, clients are too young to sell because they spend a lot of money and the company's not large enough. So we do need to take a look at that. But what you're asking is the ESOP going to net the client more cash in their pocket than an outright sale? And here's really the disconnect is, and it's a push and a pull, because the ESOP community is going to say the ESOP's going to put more dollars in your pocket. The non-ESOP community, i.e. sell-side M&A bankers that don't get paid to do ESOPs, are going to say we can always get you a higher multiple. And really the truth's kind of in the middle. Let's go ahead and set the table. An outright sale from a strategic partner, a strategic buyer, is going to pay more in purchase price than an ESOP will. An ESOP's going to pay fair market value as defined by a financial buyer. Mm-hmm. So the purchase price of an ESOP transaction will likely be lower than the offer from a strategic buyer. But I have often seen that the purchase price from an ESOP will be equal to the same offer that a private equity firm would offer, because a private equity firm is often going to be treated as a financial buyer. When you dig a little bit deeper, what I have found is the ESOP will net the client oftentimes more cash in their pocket than to sell outright to private equity or even a strategic buyer that's paying a premium, for the following reasons. And then I'm going to get into the negative. If you sell outright to a third party, typically they're going to want you to stick around for 1 or 2 years, and they're going to want to cut bait, right? They want to recapture all of your salary to have profits at the bottom line. So as a seller, we'll use the same $100 million example. You're going to sell a business. You're going to pay a capital gains tax if you sell outright to a third party. You may have a salary or an earn out to some extent for a nominal period of time. And then ultimately you're going to walk away and you're left with a lump sum of cash that you ultimately need to live off of.
And don't you think, Keith, I'm curious, maybe it's the size of companies, but you said cap gains on a third party sale. I often see asset sales or a lot of non-tax advantaged ways of the deal structure happening.
Yeah, buyers want to buy assets, sellers want to sell stock. There's a big spread there between paying ordinary income or capital gains. But with an ESOP, with certain structures, you can elect 1042, which we're not going to get into on this topic right here. But there's a provision that allows you to sell the same $100 million company with a certain structure and permanently defer paying the capital gains tax. So, you're going to save the 20% federal tax, you're going to save the 3.8% Medicare surtax, and you also have the ability to save the state tax. So let's just use a blended average of, that's a 30% possible tax savings on that $100 million sale. But additionally, with a 100% sale with an ESOP, these are leveraged transactions where you're not getting all cash at close. So what's more often than not is the seller is going to have some form of an employment contract where they're going to continue to stay on board and active with the company, at least until that entire seller note is repaid. So let's just say it's a 7-year deal. When you build the cash flows, Brian, you have a $100 million sale. If they elect 1042, they can save up to 30% in taxes, in my example, between the state, the Medicare surtax, and the federal. So that's a 30% premium in taxes. They can continue to draw a salary, oftentimes at a reduced salary, which I won't get into why, but they can continue to draw a salary for a period of, call it 7 years. They're earning interest on a seller note because they're not getting all cash at close. So maybe they get $40 million cash at close with a $60 million note, which is an obligation to the company to pay them. They're getting interest and cash flow on that note. And oftentimes they'll get a second bite at the apple.
Isn't the note pre-tax too?
If they elect 1042, the proceeds from the seller note will come to them tax deferred, or at the right structure, they'll never pay a tax.
But on that note though, Keith, isn't that note also, they're earning the interest on the pre-tax dollar of the note, not the post-tax dollar of the note, correct?
They're earning the interest on the outstanding balance of the note. So
which is pre-tax, right?
Yeah. And then they're going to pay a tax as they receive the interest at ordinary income. But what's really cool in these deals is, so they've sold stock, they get some cash up front, they don't pay a tax, they have a salary, they're still getting interest on the seller note. As the seller note is paid to them, they can avoid paying a capital gains tax on that. And then to compensate them for the risk, because I'm going to get into the negative in a moment, to compensate them for the risk of waiting to receive all the money, call it over 7 years, with these structures, a lot of the sellers will get a second bite at the apple where they'll carry equity back in the company in the form of a detachable warrant. So when you do the waterfall, they're receiving the $100 million out. They can avoid the capital gains tax on that. So that's a 30% spread in my example. They still have a salary. They have interest in the seller note, and they get a second bite at the apple, which could be significant because that means they have 10, 15, 20% of the future value of that business. So to your point, when you do the waterfall on an after-tax proceed, the ESOP will often put more cash in the owner's pocket than just selling the business outright and paying the capital gains tax. Now, here's the variable. The variable is risk. Because in my hypothetical example, if they sold $100 million to a third party and they paid a tax of 30% between the state and the federal, they're left with net $70 million in their bank account if it's all cash, right? So they've de-risked and they have that 70. Mm-hmm. When you compare it to my ESOP example, if it's a $100 million deal, let's just say that you can go out and raise $40 million of bank financing to lend to the company. All they have at the close there is 40, which is less than the 70. So my waterfall I talked to you about is going to net them more money, but it's going to net them more money over 7 years. And the risk is, do they believe the company is going to remain profitable and sustainable to be able to delever and pay them the back end of those payments? So to get back to the way that we run our practice, Ryan, one of the things that we always tell clients is to do an ESOP, you need to believe that your company has sustainable, reoccurring, profitable earnings. And you have to have fire in the belly to want to continue to work to protect the profits, because if the company doesn't remain profitable, all the Excel work that we do and the financial modeling of that waterfall, it means nothing because you're never going to get the back end of the money.
This is so awesome, Keith, man.
I'm smiling, Ryan, because I hear he just repeated. You like fed him. If you ever listen to listen to Ryan's podcast, I think he used 3 of the 4 words.
I was just gonna say
I knew you used. Sustainable,
yeah, predictable and transferable. Keith, Steve beat me to it, man. I was sitting there smiling. The listeners are probably thinking that we like had some sort of prep call for this, because I always say, yeah, doing an ESOP is predicated on building a good company that has sustainable, predictable, and transferable cash flow, and you've got energy to keep going. So you probably said a little bit more articulate than I did, but I just love it, man. It means there's some truth in there, right?
Let's hope so for both saying it, but anyhow, it was nice to meet you about a minute prior to this call.
Yeah.
Well, Ryan, I think, the purpose of, we broke these up into different sections. And one of the things we wanted Keith to talk about today was 1042. We never wanted to get into the deep weeds of 1042, but we definitely want to touch on that. And I think where I would start with 1042 is you mentioned the basics of it, of that 30% savings in tax. Let's start with this on a question on section 1042. It's only available to C corporations. And so can you talk a little bit about how much it's being used with your business owners? Is there a size business, a sector? Can you just kind of give us a general feel for whether we talk about 1042 a lot, but does it get used? If not, just a little feel for that.
So Keith, can you just give us a quick overview of what a 1042 is? Because I think a lot of people bring that up. They're not really sure about it. They kind of know there's a correlation of a 1042 and a 1031, but that's kind of the basis of their knowledge of it, but not really sure about how that implies or what the implications are on a transaction.
Yeah. The analogy we often give is the 1031 because people understand real estate. So it's always nice to kind of give a parallel to something that somebody understands, and then you build upon that. So what is 1042? It's not something that a bank created. It's not something that Wall Street created. It's a section of the Internal Revenue Code. It's a section of the Internal Revenue Code called Section 1042. It's been around since 1986. And so what's comforting about that is this is not new. It's something that's been around since 86. It's been tried. It's been tested. The structures that we've created have evolved and become better for clients to help them shelter paying any capital gains tax and candidly permanently avoid it with a step-up in basis. So what is it? It's a section of the code that says if a seller of an active U.S. operating company sells stock and they sell at least 30% of the outstanding shares to an ESOP, and that's 30% in aggregate. It could be multiple shareholders clubbing together to get to 30.
Okay.
It doesn't have to be one shareholder. But if multiple shareholders within a company, if the ESOP after the deal owns at least 30% of the shares, anywhere from 30 to 100, and at the time of the sale, it was a C corporation, then the selling shareholders have the ability to elect 1042, which means they will sell stock to the ESOP. ESOP's the buyer of the C corporation stock. They receive either cash or cash in a note, a blend. And they have the ability, if they reinvest the proceeds equal to the dollar amount sold to the ESOP within 12 months, they have the ability to transfer their cost basis from the company into other active U.S. operating companies, which could be another private business. It could be active U.S. listed stocks. It could be active U.S. listed bonds. There's a series of investments that they can go into. But what they're doing is they're taking concentration of wealth in an active U.S. company. They're selling it to a willing buyer. They're receiving cash in consideration in the form of a note often. They're taking those proceeds and they're saying, I don't want to pay the IRS and taxes. I'm going to benefit from a section of the code and I'm going to reinvest in America. I'm going to reinvest in another active U.S. operating company. And then they pause. They pause because at that point, when they've reinvested, they've avoided paying taxes. They've transferred their basis. But if your clients, Ryan, are anything like mine, they also want liquidity. So what they then do is they look at whatever they've reinvested into and they figure out if they can then borrow off that to get their liquidity. So I want to make sure for the benefit of the audience that I don't leave people with the wrong message. So 1042 is not going to give you a 30% tax savings. That was my example. Here's what 1042 will give you. It will give you a tax savings equal to the federal tax rate on long-term capital gains, which is 20, plus your state in which you reside. Every state has a different state tax. Sure. And then 3.8% Medicare surtax if you're a C Corp. So I was using a 30% as, the rolling average. Like in the state of California, your tax savings, which is a third of our business, in the state of California, your tax savings is closer to 35% because they have a 13+% tax rate. In the state of Florida or Texas, it's a lower savings because there's no state tax, right? So in that scenario, you're only saving 23.8. So I would say in aggregate on average, when you look at all the deals, I think 30% is a good kind of threshold for conversations like this. All right, so that's the technical answer. How frequently are people using 1042? I think it kind of goes back to something Ryan and he put it the right way of people protecting their relationship. I think 1042 is not used as frequently as it possibly should be used because it is complicated. But like I said earlier, it's only complicated because it's new. Once you hire somebody that can explain it to you and model it, the complexity goes away. And the right way to make your decision of should you or should you not do 1042, should you or should you not sell as an S Corp or a C Corp, should be based upon information. What I think is a mistake, Steve, is for any business owner to make the decision to do 1042 without looking at the ramifications of not doing 1042. Conversely, no business owner should immediately go into a transaction saying, I'm not going to do 1042 without looking at what 1042 would mean to them. Do the modeling, be objective, and let the math and the structure of the deal dictate as to whether or not somebody should do it. And what I found is because 1042 adds another layer of complexity, there's a lot of service providers that will tell a client it's easier just to do an S Corp transaction or you save more money at the corporate level, which you do. You do save more money at the corporate level with an S Corp, but it doesn't mean that 1042 is not the right structure. So the way I would answer your question is there's more transactions, in my opinion, that are done non-1042 than 1042. I think there's far more S Corp ESOPs done than C Corps. They're easier to do. And I don't know that the decisions to do an S Corp deal should be done because they're easier. I think that they should be done because oftentimes it's the right thing for the seller.
Got it. Yeah.
Such as if there's really high basis in the company, there's no reason to do 1042. If the owner is worried about the company being able to delever and pay back debt, an S corporation deal is going to likely be able to pay back the debt far quicker than a C Corp. So my answer would be let the math, let the modeling dictate to the structure. Don't let the simplicity or the ease dictate the structure.
I was just going to say, you take a margin loan against your stocks in a different entity. Yeah.
And so based upon how liquid the client wants to be or based upon what they've reinvested into, there's instruments that have been created specifically for 1042 where clients can get a loan to value anywhere from 50 to 70% backed by a blue chip dividend equity portfolio or up to 90% backed by an ESOP bond, which is a long-term debt instrument of an active U.S. company that has certain mechanisms to protect it from interest rate risk and credit risk. So a client can reinvest their basis, borrow up to 90% off that, and then when they have the cash, they can go do whatever they want with it. They can, buy real estate. They can put it on their mattress. They can go on the market. They can go buy art. It's their capital, and they've permanently avoided the tax with a step up in basis. That at a very high level is how 1042 works. To come back to your question and use the 1031 example, it's very much like a 1031 where if you sell real estate and you come into cash and you don't want to pay tax, you can go buy another piece of real estate, and then you exhale and you pause. And then if you want liquidity, you can take out a mortgage, and a mortgage is a loan backed by the real estate, which is a non-taxable event. Now the client has cash and they haven't paid tax on the sale of the real estate. So it works very much like the 1031 with real estate.
So once I watch people's face when they hear this, they're like, it's like the dog that wants to go catch the car. And so one of the things, people like will either knee jerk and want to go change into a C corp immediately, or because I don't know what the stat is out there, Keith, but like 5% of small or privately held companies are C corps these days. So it kind of goes back to the applicability. But like for someone that's not a C corp right now, what are what's the timeline and implications of changing into a C corp and then going down this route?
Yeah. So I've got to at some point during this podcast put this out there, right? Because we can't give tax or legal advice. I work for a big bank, so I'm not good. So what we will say is the really smart accountants and lawyers that we surround our clients with are going to help them with the proper tax advice to say, if you are an S corp, there's a way to dissolve your S and go C, and then you wait 5 calendar years before you flip back to the S. So the bulk of the 1042 deals that we do are for companies that actually came to us as S corps. Because to your point, there's
okay.
more S's than C's. And so what happens is it's all math. They look at the model and they say, all right, if I sell my S corporation stock, I'm going to pay a capital gains tax equal to the federal rate and the state rate. So I gave 30% as a blended average earlier. Well, clients don't like to pay tax if they can avoid it. So with a smart group of advisors, they can essentially say, well, model out the math of if I dissolve the S and I go C, which allows me to do 1042 and not pay a tax, what is the harm that does to the company, right? Because the S corp is very clean. The company's not going to pay tax to the extent that the S corporation owns the stock. And so with a C corporation, they have the ability to have deductible contributions in that 5-year period while they're waiting to go back to an S. So where the math is really cool is can the client get the best of all worlds? It's called the S to C to S conversion. Can they get the best of all worlds where they dissolve S and they go C, they sell C corporation stock to avoid the personal tax, but they don't want to put the company in a bad scenario. So while the company has debt outstanding affiliated with the ESOP and they're operating as a C corp, can the company create enough deductible contributions in that 5-year period of time by making a contribution off the company's balance sheet equal to 25% of payroll, which is outstanding with the loan, and sometimes a deductible dividend. So you're able to mitigate or zero out a lot of what would otherwise have been taxable income. The company's making a deductible contribution to the ESOP, which is a retirement plan. ESOP gives it back to the company. They pivot and pay down debt. And if you can work through that math over 5 years, you then flip the company back to an S corp. And now you've got the best of all worlds where a seller sold stock, they avoided the personal tax. You were able to make the company pretty darn tax efficient in that 5-year period of time with the tax deductible contributions. And then you flip the company back to an S and the company's operating tax exempt. And again, what I would say, Ryan, is it's not that that's the right structure for an S corp today, but it's the wrong thing for the company to not look at that structure to figure out, can they pull that off versus just going the S corp route. They really should be objective and have individuals that are going to look at both structures.
So Keith, you talk about the C corp to or S corp to C back to S and what we're doing. And I love the fact that you have that knowledge to help clients, because often clients just don't get that advice to say we should at least look at it. It may not be right, but why not look at it? dream for me for a little bit, and that is, I've been doing this since 1996, and I think the same bill has been in Congress since the very first time I went to the Hill in 96 to try to get S corporations on the same playing field as C corporations and allow 1042. We finally made a little tiny blip. We're in a part of a retirement reform bill that's supposed to be hitting the floor and maybe get a vote in it. But if it happens, 10% of the gain of an S corp would be deferrable, not 100%. Dream for a little. What happens to the creation of ESOPs if S corporations are allowed? An owner of an S corporation is allowed to defer 100% of the tax. Do you think it changes a lot, or just changes what you go through to get there?
With the 10% rule, like
with 100%. If the 10%, I think we could talk about 10%. I don't think 10% is going to move the needle at all. I just don't see that as being helpful at all.
Level set to make sure we agree with that.
I was just going to say that's a lot of work for 10% deferral.
Yeah. No. So, but what? Let's dream and let's say we get it to 100%. Well, what's that do for the ESOP world? What's that do for smaller businesses? I have my opinion, but I'll let you talk.
Yeah, I think that this is, not to be coy, but I think it's a common sense answer. You're increasing legislation in this hypothetical example of enabling companies or business owners to make a decision where they can sell stock and pay no tax, and the company can operate tax exempt from the beginning, all for the benefit of this company growing, and then distributing shares to the rank and file employees of a growing entity where they now are accumulating wealth that they can rely upon in retirement. I mean, that's the whole concept of this is with a 100% wholly owned S corp, the business is growing in value, which is benefiting all the individual shareholders who otherwise would have no ability to have equity in this company.
Mm-hmm.
So I think the derivative effect of increasing legislation to make 100% wholly owned S corps eligible for 1042 would just simply be a dramatic increase in the amount of employee ownership, because it's an additional tax savings to the decision maker. Because the decision maker to do an ESOP, and elect CRS is the business owner. And the common sense approach is, what business owner would not like more tools or more options to be able to make decisions where they're keeping 100% of their proceeds and not paying a tax? So it would be a dramatic lift to the amount of ESOP activity, in my opinion.
And the economic growth, the overall equity growth in privately held companies, and the whole ability for the rank and file, like you said, Keith, actually grow equity is good. We're a consumer-led economy. We need people to be able to afford to buy stuff, right? Steve and I were rallying after one of our last recordings. It's like, my God, what that would do for owners actually getting off and doing something instead of being stuck in their company because they have to pay the taxes. There's like on the smaller companies, you have SBA loans or conventional loans. That's you're paying the taxes. The company still has to pay the taxes on the proceeds. The company still has to pay taxes. You have to service then the bank debt, and then it's like you have no room for growth, and then the employees don't get access to it. So it's like you're just freeing up that whole. You're greasing the wheels to be able to actually make that happen and actually get people to act.
And the abuse, if you think about it, I haven't heard this, but I think maybe one of the pushbacks is this a tax loop? Is every business owner going to go out there, sell their business to their employees, and then it's tax free and then nothing really changed? They still run the business, all of that. The mechanisms that are in place nowadays with the Department of Labor and where this industry has gone, it's just ridiculous to think that way. So I would agree 100% with Keith that it would just open up. We would have so much more employee ownership, but we just can't get there.
So, Keith, this has been a lot of fun, man. I really appreciate your style and very well thought through answers, man. It's especially on a complicated topic like this, so I appreciate it a lot. Where can the listeners find more about you and your firm?
Google. where else? What better answer? Google.
You didn't say Bing? I mean, come on, man, isn't it?
So we run the Capital ESOP Group. We're based out of Washington, D.C. within UBS. And if anybody wanted to reach out, our obligation is to make sure with the 10-person team that we should have the bandwidth to get back to people same day.
Awesome. Thank you so much for coming on the show, Keith. Thanks, Steve.
Thanks for having me.
Thanks, Keith. Appreciate it.
So good morning, Steve and Miguel. How are you? And I'll let Miguel go first because Steve and I are learning.
Good morning. I appreciate being part of this podcast. Thanks for the invitation.
Hey, Ryan. It's good to see you again. I think, what are we, number 5 now? Number 4, number 5.
I don't know.
So, yeah.
They're all rolling together. You just like sit there waiting, like, are we gonna, who's gonna talk first? I'm excited for this conversation because in our trainings, when I'm talking about ESOPs, so many times the owners are talking about like, hey, I got this key executive, or I got this team that's been with me forever, and they're a little bit older. And how does that impact their ability to get their share that is fair for them, but also then how do we help recruit and hire other executives? And so I think there's a really interesting conversation that we're going to be able to dive into, especially from your perspective, Miguel. But I want to tee it up to you, Steve, if you want to kind of just introduce Miguel, and then we can let Miguel, your relationship with Miguel and his firm, and then also we'll let Miguel do his background.
Sounds good. Yeah. Miguel and I have not known each other for a real long time, but Miguel is a national service provider for EOX and a great supporter and ambassador for employee ownership. So I'm excited to have him on today. Miguel Paredes from Prudent Fiduciary Services in the Los Angeles area. And I will let Miguel, just why don't you introduce yourself and just tell us a little bit about how you got into the employee ownership sphere, and just a little bit about what your firm does.
Sure, Steve. So really briefly, generally my background is a business background. I have a business degree. I have an MBA. Spent most of my career early on in the financial services area. Most notably, I was part of a corporate audit department of Mass Mutual Financial Group, Fortune 100 company in Massachusetts. And as part of my auditing duties, I audited that firm's retirement plan platform. And in my final year there, I started focusing more on fraud detection, fraud investigation. And there was an event that led me to an interaction with the regulator of retirement plans. There was an unfortunate incident that occurred where a Mass Mutual rep borrowed money out of a 401k plan.
Borrowed in quotes.
And promised to put it back. But so the Department of Labor has an agency under its umbrella, the Employee Benefit Security Administration. And this agency launched an investigation into this unfortunate incident. And it was my job to help the agency understand the steps that the corporation had taken to rectify the issue. During that interaction, the Department of Labor official turned to me and said, Miguel, very impressed with your work and your background. We are trying to bolster our ESOP enforcement program, and we think you'd be perfect for that. So that's when I first really started learning about ESOPs, and I pursued that opportunity, and I joined the Department of Labor agency in their Los Angeles regional office.
Oh, cool.
And through training and really the intent was to have me help really focus on that ESOP enforcement program. So I was at the department for 12 years. I oversaw a team of 10 investigators and really was delegated that office's ESOP enforcement program and was essentially the in-house ESOP expert for that agency office on the West Coast. So my team and we reviewed hundreds of ESOPs while I was there. We looked and reviewed ESOP transactions, the ongoing administration of ESOPs, really always focusing on the ESOP fiduciary. So we wanted to understand what the trustees, for example, are doing in the space. Are they fulfilling their fiduciary responsibilities to the ESOP, to the participants? And so that's really where I cut my teeth in the ESOP space. During those 12 years, I learned all the ins and outs of ESOPs and developed a high level of expertise relating to what it means to be a good fiduciary, what are those missteps and issues, breaches, etc. So around 2016,
which I was just gonna say, Miguel, it's such a cool perspective, because after even talking to Neil, it's like, who manages Neil, right? So it's like, you kind of get to. I think that's just super fascinating, probably for the listeners, because it's always trying to wonder, like, put faces to the people that are actually part of the process ongoing. So that's super cool with your background.
Yeah, it was definitely it's a unique background for a practicing trustee, and it was one that really, again, was vital to me, really learning everything about ESOPs and specifically becoming a fiduciary expert. And then around 2016, I realized that there seemed to be a need for good independent ESOP trustees in the space, and I
A
realized
few
that I
bad
could
ones.
I was gonna say, is that from 12 years of like seeing what they're
right.
doing, like, they're just missing some good ones.
We saw some good trustees, and there were some that I, like, oh wow, this a little surprised that some of them didn't have a proper understanding or appreciation for their fiduciary responsibilities. And I realized that I could take the expertise that I developed and the best practices and be a practicing trustee myself. I had developed a passion for ESOPs as a regulator of ESOPs. And I said, I think I could be a practitioner and leverage what I've learned, and quite frankly, execute that role of trustee better than anyone I had seen in the industry at the time. So I made what was a pretty difficult decision in February 2017. I left the department and formed Prudent Fiduciary Services. So I'm the president and founder of Prudent Fiduciary Services, and I'm very grateful that I was right. There was a need, and my unique background as a former regulator has really resonated in the space. And so we've grown tremendously. We've helped over 200 companies across the country form a new ESOP as a trustee of that ESOP. And
since 2017,
and have
buckets.
also come in as a successor trustee for many other existing ESOPs. We've built what I think is a really great ESOP trustee team. I was able to lure away 4 of my former Department of Labor colleagues from my time there. 3 of the 4 are attorneys with a lot of fiduciary expertise and certainly ESOP experience and expertise. We also have 2 in-house accredited senior appraisers as part of my staff, former CFO of an ESOP medical companies with me full-time, and others. Cool. So we're now 16 full-time, and I'm really proud of the team that we put together. And again, every one of us works very hard to help with any way we can in the ESOP space, in particular as a fast-growing trustee organization.
That's awesome, man. That's congrats on the success, and it's while helping people. So like, you're successful and you're helping other people move into something that's pretty cool. Steve, you want to kind of tee up the topic and kind of like set the stage, because I think I'm pretty excited for this one, because I know that these conversations are ones that I have all the time.
Yeah, I think you teed it up a little bit before, but I think we want to talk a little bit first of all about selling shareholders and what stock, equity outside of the ESOP looks like, what value looks like in an ESOP, and then spend a little bit more time talking about what you teed up, Ryan, which is how do key executives play into all of this. We know it's broad-based ownership, but how do we reward and incentivize key managers? So let's start with this question, Miguel, and that is, how often do you talk with selling shareholders? When you talk with selling shareholders, how often do you find that they put value on things like leaving a legacy in their community, being able to continue on as a CEO or a board chair, and any other things that you think the ESOP brings as value, which will break us into the next question, which is, what is value, and is there a myth about ESOP value? But maybe let's start about just your experience in working with selling shareholders, what they tell you.
Yeah, absolutely. Typically, on the front end of an engagement or a potential engagement, in particular, if I'm being interviewed for a potential engagement as trustee for a new ESOP formation, I'll be interviewed by the seller, and they, of course, ask me a ton of questions about my background and experience and the role of a trustee. But I oftentimes get a chance to ask questions, and one of the things that I always want to understand is, okay, Mr. Selling Shareholder, you have other options. Why an ESOP? And of course, I'm very passionate about ESOP and I have a good idea why. But and they'll start talking about some of these different aspects of selling to an ESOP as compared to the uncertainty of selling to a third party and all that could bring, mm-hmm. Right? Massive change, loss of all control. And so when you sell, for example, to a third party, and somebody else is going to come in, and that selling shareholder many times is, that's the exit. The buyer says, "Thank you very much, Mr. Seller. We're going to take it from here." And so what it does is it many times jeopardizes the culture that's been built. If you have, maybe the buyer will start talking about redundancies and firing a lot of the employees that have helped build that business. And so that could sometimes, selling to a third party, obviously it happens very frequently, and it can go well, but there's always a risk of that really going sideways. And so some of the benefits of selling to the ESOP trust for a seller, of course, that we talk about in these discussions include being able to keep what you've built, keep the culture, and have your employees not only build on what might already be a great culture, but take it to a whole new level now that you're becoming employee owned. And instead of having one or two owners, you can now have a company full of owners, and everybody. And when you do it right, having a company wide common view of with that employee ownership mindset, and really can be go from maybe a good culture to an extraordinary culture. And as you guys know, studies have shown that employee-owned businesses are tend to be more successful than their non-employee-owned peers, are more resilient, have better long-term success. And so, and that's because everybody has skin in the game, and instead of just the value creation going to one or two people, it goes to everyone. So that's keeping the culture, keeping what you've built, and then absolutely for the owner to be able to still stay very involved and lead the company. And that notion of control is actually something that is very important and is really on the front burner of a lot of us practitioners, in particular because my former colleagues at the Department of Labor have really made this a focus, right? They sometimes have taken the position, wait a minute, we have an ESOP that's paid consideration for a controlling interest of a company. Does the ESOP have control in fact? And so, well, what does that actually look like, and what does that mean? And sometimes I think my former colleagues have mistakenly overstepped in terms of having an unrealistic expectation of the trustee's role. And they almost seem to advocate for, well, the ESOP paid for this company, and the trustee should be somehow involved in running of the business. And as you guys know, that's not the trustee's role. Certainly a good trustee has an oversight role as a responsible shareholder to be comfortable that there's a good board of directors in place, and they're going to vote the shares owned by the ESOP in the formal election and re-election of the board. But trustee should not be involved in strategic decisions. I'll give you an example. If and I used this example recently, and I think it really resonates. If Amazon wants to do an ESOP, and Jeff Bezos says, "Hey, Miguel, we want to hire you as trustee, but do you mind if I stay on as president and maybe stay on the board and kind of direct this transition over time?" And if I said as trustee, "No, Jeff, we're good. I've got this. The ESOP on your company." So, yeah, how is that? Again, the Department of Labor wants the trustee to think about what's in the best interest of the employees at all time and the ESOP participants. Well, how is taking the keys from Jeff Bezos once we convert to an ESOP in the best interest of the employees? It just doesn't make any sense. And so that's a great aspect for a selling shareholder, in that it allows for a reduction of that succession risk, because they could stay on for as long as they want to be involved. Of course, assuming that selling shareholder is acting in good faith and is being an effective leader. And of course, we'll talk about some of the things that help align the ESOP and that selling shareholder in wanting to make sure that the company's growing and doing well. So those are other intangibles, and then just being able to, as a seller, being able to make what you've built and make it even more dynamic. That I see a lot of sellers that are excited about the potential of rewarding their employees, rewarding those that have helped them build this business, and seeing and having the foresight to see the potential for what this could be in the future. And so those are some of the elements that we talk about. And I think those are
Miguel,
all points that you're not going to get from selling to a third party.
Miguel, I want to throw out a concept too, because that we teach a lot in our training. That is this: you have to separate your leadership management role from the equity ownership role. And so many times when people call me like, "I want out," it's like, well, they usually want out of their job. They don't want out of their dividends. So like when we clarify that, ESOPs, to your exact point, become a wonderful mechanism for someone that wants to monetize the asset that they've grown, but still want some degree of control over the strategy, the future direction. If they're burnt out, that's, ESOP's not going to solve that in a bad management team. But I think what you just hit on, I bring up the concept because I talk a lot about that on the show. It's like, hey, you got this leadership management role, and then you've got this ownership role, and you have to figure out what you want for both. And they don't have to be simultaneous. And so many people think that they have to be, like you said, some to a third party. They generally come correlated, and they both walk out. But like it's an interesting option to manage the future culture and strategy because you're still involved into the leadership aspect if you so choose. That kind of tees up, I think you said, Steve, and moving into like once you're truly just as a leader, once you become an ESOP and you got an executive team, it kind of moves into then what does that mean for them as a leader of this new entity that, the ESOP that's no longer their personal piggy bank per se.
Yeah. And, to wrap up on the selling shareholder piece, I think we've talked about this, with every guest. And one of the myths that I'm on a mission to make no longer a myth is how much truth is there to the comment of when you sell to an ESOP, you don't get the value that you don't get the highest value you can. And is there any truth to that? Is it a myth? Is there somewhere in between? I think most people think there's somewhere in between. But Miguel, could you talk a little bit about that comment that people make that you can't get the value you deserve, I guess is a better way. You can't get the value to deserve in selling to an ESOP. And much of that comes from the topic of the day, which is stock appreciation rights or warrants. Can you talk about how that helps to cause to fix that statement because of the fair market value?
Yeah, absolutely. I do think that it's an incorrect myth, but it's not a straightforward answer. But I'll tell you here that the basic concept of an ESOP transaction, from a regulatory standpoint, the definition is that a trustee, for example, goes through their diligence process and they have a mandate to ensure that the ESOP pays no more than the fair market value for the stock that it's purchasing. But it doesn't say that the ESOP is prohibited from paying the fair market value. So I always tell sellers that as a trustee, I'm committed to a good faith negotiation. I'm going to represent the ESOP. But I understand that it's got to be a win-win. It's going to be a win for the ESOP in that I'm going to advocate for the employees and the ESOP. But I understand that it's got to be a price point and terms that are at market. That means, and the fair market value among, the kind of the primary definition is what is a price that a willing buyer and willing seller would come to in the marketplace, and where each party is, the buyer is under a compulsion to buy and the seller's in distressed and under compulsion to sell, but that willing buyer and willing seller fair market value concept, and so that means that the terms have to be agreeable to a seller and be indicative of fair value. Now, the ESOP is a financial buyer; they aren't the ESOP isn't a strategic buyer, so there may be a firm that sees some value and is willing to overpay just to get into a particular market or to be able to have access to a particular client's customers, and will have some inherent synergies that they're willing to pay a strategic premium. And so in that scenario, yes, it is true. In that specific scenario, which isn't always the case, that the ESOP cannot pay a strategic premium. However, most of the times the ESOP is paying fair market value through a robust and good faith diligence and negotiation process. Now, there are other aspects in the ESOP in terms of the favorable tax treatment. I know that there was a session on 1042 and that those financial rewards to a seller, and certainly we'll get into a little more detail, things like warrants for a seller that allow the seller to, warrants.
Feel free to go right into it, Miguel. Seriously, feel free to go right into this.
Yeah, no, absolutely.
Like the technical nature of it.
So, as I've said, we've been involved in many transactions over the last 5.5 years, and the overwhelming majority of those have a warrant component. As you know, they'll have typically an ESOP transaction will have some bank debt, some senior debt, but in almost every instance, the seller also finances a portion of that transaction and will write some seller notes. And warrants are a key part of that because, as you know, when we're talking about risk to return concepts, that seller is holding at the end of the transaction subordinated debt, and they're in what we call the position of the first loss position. In other words, they're bearing really a huge part of the risk of this company being able to continue to do well and be able to repay that obligation. And so what warrants do is allows the ESOP company to pay a reduced coupon rate, where they don't have to pay 10, 12, 13% coupon rate commensurate with the return that type of note holder requires for the level of risk they're taking. But maybe the coupon rate will be 4 or 5. Well, these days probably more like 5-6% current interest rates. But then allow that seller to have an all-in return of maybe 11, 12, 13% with warrants, which as you know are as kind of stock option like instruments that allow the seller to be paid over time if the company does well and is repaying the debt and is growing. The value of those warrants grow. And really what's great about this tool is not only does it allow the company to have lower cash interest payments, which are supplemented by that warrant, but it also aligns the incentives. Now you have a seller that, of course, wants to be repaid, but also will have financial rewards in these warrants if the company does well and performs well. And if they underperform, those warrants, guess what? Those warrants aren't going to be worth as much as they otherwise would be. And so it's aligning the.
So Miguel, can you unpack just a little bit? Yeah, no, I love where you're going with this. You're spot on. Is like explain a little bit more detail of like how that warrant works. So if someone foregoes instead of the 12% interest rate coupon rate and they choose at like 6, how does that, like, what exactly is a warrant, like the stock option? How does that manifest in towards like kind of the equity alignment, like you're talking about, like mechanically, how does that work?
Yeah, so warrants are synthetic equity that are provided to a seller. They're as part of an ESOP transaction, and they're very common in many M&A transactions. They're certainly not just a creature of the ESOP space. They're very common in all types of corporate transactions. What it does is there are warrants that are granted at closing, and they're negotiated in good faith, and they're typically negotiated in terms of an overall return. So there are calculations done that will say, okay, this seller is requiring a 12% all-in return. And so we'll say, okay, well, we're going to provide you with a 6% coupon rate on your note, and that other 6% return is represented by whatever the appropriate number of warrants are, 100,000 units of this synthetic equity, whatever the number turns out to be. And so they are issued post-closing. Typically, there is an initial strike price that represents that post-closing equity value at issuance. And the return that seller gets is when then there's part of the negotiation is the term of the warrants, et cetera. And so the value that seller gets is the difference between that initial strike price and then the growth of that equity value in the company over time, and a payout at the end of that warrant term for the difference between that initial strike price and the equity value, the strike price at maturity. And so that's how it works. And again, a very effective tool because it provides that return that the selling shareholder requires for that subordinated debt in the marketplace, but also aligns. If the company's doing well and is profitable and even exceeding its expectations, that warrant's going to really increase in value and reward that seller. And to the extent that seller's still involved in helping drive value, that's a real win-win, because when the company's doing well, the ESOP's doing really well. And so if the company may be just middling along and not doing as well as everyone expected for a variety of different reasons, then that the value of those warrants will also reflect that middling performance. And so again, it aligns those incentives really well. And it's again, in my view, an effective tool. Now, they aren't without some controversy. Again, my former colleagues, I think are becoming a little bit more, certainly, I think, educated on warrants and how common they are in these type of corporate transactions. But I remember early on that sometimes there was a concern about, well, wait a minute, the ESOP is purchasing 100% of a company. Let's say it's 100% ESOP implementation transaction, and you're giving away 20% of the equity in this warrant. Shouldn't the ESOP only pay for 80% of the price that it just paid? And that's really an incorrect conclusion and oversimplification, because you're not giving away 20% of the equity. I mean, certainly warrants are measured in terms of their dilutive impact from a cash flow perspective, but all the stock is owned by the ESOP. This is a synthetic equity instrument that is purely an effective financing tool to provide an appropriate rate of return for a seller. That's what it is. And
based on future growth, right?
Yeah,
So like the ESOP has to grow, so the 20% comes from the future growth. Which what I love, Miguel, is like if you think about the comparative, like the comparison is like, some people are like, I'm going to sell to a private equity firm because then I can roll 20% and get the second bite of the apple. But you have a boss, you have the general partners and the limited partners, and you have technically you're just an employee. Yeah. With this, you have the second bite and you have a lot of control. Like it's like so similar, but yet potentially even more advantageous if you're bullish on your own company.
Yeah, and absolutely, it could be very advantageous for the seller. Again, it aligns the goals of the ESOP and the seller. And and there've been times where, in the instances, you could show that warrant has protected the ESOP in that, in the alternative, instead of paying a 12% coupon rate where that rate of return is guaranteed, you're writing a check, you're paying that 12% interest if you don't have any warrants. In instances where there is some, the performance isn't what is expected, the overall payment to the seller is less than what you would have otherwise paid if you had no warrants, because again, they're performance based. Mm-hmm. And so that's there are many instances where that's the case, where having these warrants has been beneficial to the ESOP where there's been underperformance, because the cost of the ESOP has been considerably less than what would otherwise if it was just a straight coupon note. So yeah, absolutely.
And I love think,
it. Tee it up to you, Steve, because this is a great entry point, I think.
Yeah, because I've watched, it wasn't part of my career to really think about and to see what the warrants were for the selling shareholders. But I can tell you, the more I pulled myself away and started working with these ESOP companies, it's amazing to see how interested and how involved the selling shareholders are, because they hear about these warrants at closing. They're promised this, not promised, but this is how we're getting to the return of 12% or whatever that number is. But it's all so foreign to them. They have these warrants, and all of a sudden, about year 2 or 3 in, and they see the strike price was at, the issue price was $10, and now the share price is sitting at 60 or 70. It's amazing how interested they are in their warrants, and interested in how can I get. I mean, I've got 4 more years until this thing, before I have to turn these in. So it's amazing to see how involved they are, how they let their employees kind of run with it, but yet still think, okay, I need to be here for them. I need to be that mentor. Which brings us into the next thing is, these warrants are also available at closing time for senior management, key executives, future executives, same sort of concept. But I think in my experience, there's performance warrants, just like what you have for the selling shareholder, and maybe even some retention warrants. Can you talk about how you take this concept then beyond the selling shareholder to those key executives? Because I think that's, like Ryan said, that's probably one of the biggest questions he gets is, how does that work? If this is broad-based ownership, how do I get my key management to buy into this?
Yeah. No, I mean, it's a great point, Stephen, and you're exactly right. ESOP is very egalitarian, right? It's broad-based. It's meant to really reward all the employees. And so how do you target some of those key leaders, the key drivers of value, specifically and incentivize them? Yes, they're going to be participating in the ESOP, but certainly as the ongoing trustee for an ESOP company, I want to be comfortable that the board and the leadership team has those tools to be able to reward those key drivers of value, those key management, to be able to attract key executives and to be competitive from that perspective. And so that's certainly in the best interest of the participants, and something that I think is very important. So is the only difference, Steve, is that these are typically referred to as stock appreciation rights. So, but it's almost identical to a warrant in that it's synthetic equity, has an initial strike price, and the same concept. Over time they vest, and those key executives are rewarded by that growth in the value of that synthetic equity that they've been granted. And you're right. So stock appreciation rights are part of a management incentive program. It's very commonplace when we're implementing an ESOP. And as I said, I view those in a very positive light, in that you want the company to have those tools to be able to reward and retain and reward key executives driving value. And so typically that program is at least the parameters of that synthetic equity program. The stock appreciation rights are part of the overall negotiation. The sale of the stock price, the financing, the warrants, and then if they're contemplating a stock appreciation right for management, then that's part of the overall negotiation as well. So,
when you say negotiation, Miguel, when you say negotiation, you're talking like what percentage of the ESOP transaction would be a SAR,
yeah,
or part of
for
the SAR
example,
plan or something?
Yes. How many SARs specifically are we talking about in terms of, again, a percentage of the equity dilution, even though there is no actual equity dilution, but that's kind of how you measure it. And then, okay, well, let's say you want a 10% block of equity dilution set aside for key management. Okay, well, we have 10%. Are they all going to be retention SARs, which means that they're granted right away to those key executives, or they're granted over time, but there aren't any metrics that need to be met for granting? They're meant to help incentivize and retain key management, or are they used more as a carrot? Maybe we'll have some percentage that are performance SARs, and so those will be granted only after those executives have helped the company meet these performance objectives, typically tied to some sort of earnings objective over the next number of years. And so typically we'll see, let's say if it's a 10% block, we'll see 5% retention SARs, where the leadership team can grant those to key management right away or over time. And then there's another 5% that has to be earned. Those key leaders need to earn that before it could be granted, and then they could start seeing the appreciation from that standpoint. And so typically that's the difference between the retention SARs and the performance SARs. But again, those are very effective tools to incentivize those key leaders to help continue to drive value and be rewarded in that synthetic equity, with the payout once that synthetic equity matures, the delta between that starting price and the current value at the time that they're executed. The better the company does, the higher the equity value, the more those SARs are worth, and the more that those key executives are rewarded. So again, aligning the interest, because when the company's growing and doing well and increasing in value, that's nothing but good for the ESOP participants as well. So
I've never heard it broken down into a retention and the carrot like that. I really enjoyed that. And what is it accurate to say, Miguel, that like the retention would be the retention chunk or classification could be applicable to like the question I always hear is like, hey, we're going to do an ESOP, and Steve's on, my key executive, and he's 65, but we're doing the ESOP, and Steve's not going to be able to get rewarded for his 30 years at the company because of, X, Y, and Z. So is retention part of like helping people vest and, getting some of those people that have been with you for a long time, or is that more post transaction?
Yeah, it's a good question. Typically the retention SARs are really just that. You want to reward key executives right away with the granting of these SARs so that they could start being able to take advantage of the growth in that equity value from pretty much from day one, the day they're granted, instead of having to grant a SARs after they've already reached some performance levels, and then the value creation that they get to participate in is from that point forward.
Got it.
For there to be value, though, as you could imagine, you do need some time from the time that they're granted to be able to have at least a few years of growth so that you can build that delta between that initial strike price and that fair market price of the stock at the time that you exercise that SARS. And so if it's somebody that maybe only has a year or two left with the company at the time it's granted, it's not going to be that much of a reward because you just don't have the time to do it. And we have seen some of our, and because that is right. It's a little bit of a conundrum because ultimately when you sell to an ESOP, it's a retirement plan. It's a long-term plan. And if you're younger and you have more years to be able to participate in the ESOP and get that the allocation of stock year after year after year, and with that, not only are you getting more stock, as you know, you're also participating in that. Hopefully, that increases the value of all those shares that you receive. The more runway that you have, the greater the expected value of your ESOP account is. And if you've got a shorter runway, it's not quite as effective. But we've seen some of our ESOP clients do special bonuses to reward some of those key executives at the closing, kind of a transition bonus or something like that, because that could be more effective if you've only got a year or two left in terms of your service when we were implementing an ESOP.
Got it. And just for the listeners, Steve is not 65.
No, I'll add on those performance stars. One of the things that I've seen recently that's really cool to see is that, senior management on the retention SARs in a company that I know, they're still receiving payouts on a performance basis. I think the retention SARs might be done now. They're long enough into it, but there are new people that have come along on the management team that they feel are a valid part of the growth and helping them to earn extra dollars for these performance stars. And I've actually seen a management team, they could issue new shares to new, an HR director or a business operation manager, CEO, someone who's come in, grown up in the company and now deserves that. I've actually seen them take SARs away from themselves because there's only a certain pool of them to say, look, we realize that these people are helping get us to where we are. We need to, share in that because we don't have enough to share, we don't have enough performance to go around. So it's been really cool to see, that working together like that and add new key executives. So, it's been fun.
Yeah. And it's something that the board, typically we'll have a board, or maybe you'll have a compensation committee. And that's part of what they should be discussing is we've got the SARs program. Do we need to alter it a little bit? Maybe if certain SARs have sunsetted, maybe re-up some SARs, make them performance-based, and so that you can reward those future leaders in the company and have the tools to do it. So, yeah, absolutely. It's really always from my perspective when I look at those things, I just want to make sure that it's always about relative fairness, right? Is it it's got to be in the best interest of the participants, in that it's in their interest when you have a leadership team that's incentivized to do well and to help the company grow and to add value. That's certainly in the ESOP best interest. But if they're granted half the equity and it's really dilutive to the ESOP, that can be overkill. So it's always about a good, reasonable incentive plan that's relatively fair overall to the ESOP, but still effective to reward key management. That's something that from a trustee, that's kind of always what I want to get comfortable with.
And Miguel, it's so crazy. Everything we're talking about, it just aligns every single person. It aligns the previous seller, the executive team, the board, and towards that equity growth. I mean, so many times that I've heard people and maybe some older ESOPs where it's like, hey, we're focused on net income. I'm like, what? Like, what? You out of all people shouldn't be talking about net income. You should be talking about the share price and equity growth. And this is really getting everybody in line to make sure that, even the person that sold is still kind of beating everybody over the head, like equity growth.
Exactly right. No, they're great tools. And again, that's when you're really humming as an ESOP company, when all the incentives are aligned and everybody's acting in good faith and working hard to grow the company. Because at the end of the day, that's what it really comes down to, is the company needs to be profitable over the long term and do well. And that's when the magic really happens, certainly. I
love it. Steve, anything that we haven't covered?
No, I think we did it well, Miguel. It's a great explanation of how this works. I think it's a key component. There's so many things that happen in an ESOP transaction that are foreign to selling shareholders and everybody involved. And I think the SARs and warrants get overlooked too many times to be talked about. I think they get talked about during the transaction, but when the education is out there, it's just too deep. You don't want it's hard enough to teach people what an ESOP is. And you go that deep, their eyes are already glossed over. So I think this is a super important topic, and I appreciate you coming on today, Miguel. Did we miss anything that you wanted to cover before we wrap up?
No, I think it was a fun conversation, and if you come up with any other topics, I'd love to be a part of it again. So really, thanks for doing this. I think this podcast series is really cool, and I can't wait to listen to it.
That's awesome. Miguel, where does everybody find you?
Well, you could find me at www.fiduciaryservices.com or www.prudentfiduciary.com. Either one will get you to my site. Again, we're based in Los Angeles, but we have a true national practice with ESOP clients from Honolulu to New York City and everywhere in between. And you could always find us at, I'm a frequent speaker at different ESOP conferences. I'll be speaking in Vegas in November, and we'll certainly be part of so that's the ESOP Association conference in Vegas in November. And we'll certainly be a big part of the NCO conference coming up in April 23. But we're at every major conference, and stop by and say hello.
Miguel, thanks so much for coming on the show. And Steve, thanks so much for setting this up.
Thanks, guys. This was fun.
That's right.
Enjoy the rest of your day. Take care.